All right. Stock started the day on a relatively bad note, going into the OPEC meeting. Came out of the OPEC meeting on a really good note. So we actually rallied really well throughout the pretty much most of the day, closing near the highs. Could have been a little bit better close, but dang, it was a pretty good move, considering the really strong move we had the prior 2 days. So I'm going to talk about how significant it was, that we're still holding up here after a strong rally, that we didn't give it all back or give a good chunk of it back. So I'm going to talk about our bullish expectations going forward. How much further or higher can we go? Is this a trend changing rally? So that's an important discussion. Everybody's calling this. Everybody always wants to know, is this the low point of the year? And so we'll talk about that and talk about whether I think that's the case based off these indicators and where we can go up or down to if it's not. So we're going to break all that down. We're going to take a look at what's driving the price action today. A very common theme that we've seen for most of the year. So we'll look at that. We'll take a look at the sector moves. Not exactly your most risk-on sector rotation that we saw today. So we'll break that down, for that matter, over the last 3 days. And then our trade idea is a stock that's that hasn't been participating in this bearishness for most of the year. Has had its own little good rally, and we'll talk about what we're going to do with that stock, considering our broader market expectations. So let's go ahead and get started. Today is Wednesday, October the 5th, 2022. This is the Market Outlook from MarketScholars.com. My name is David Settle. All right, before we get started, I invite you to subscribe to our YouTube channel with that icon here or the subscribe button down below. Also hit that thumbs up icon to like our video, comment on anything that stood out to you today. Join our website at MarketScholars.com with that link up there in the top right corner of your screen. Follow me on Twitter for more content between the videos from day to day, and join our Market Outlook Facebook group that we've created. All right, if you're watching us on our blog, check out these classes over here on the right-hand column. Come down to the bottom, hit that heart. It opens up a new tab. Hit that like button. Also hit the thumbs up icon. It opens up another new tab. Hit that like button there too. Again, that really helps us out. We get 123, so thank you. I think that's the highest number I've seen in a long, long time. So thank you all very, very much for clicking that and clicking it again and again and again. Really helps get our content out to all of our followers on both those platforms. All right, really quickly again, I wanted to just mention a few of the comments here. So thank you to Mary and to Paul again for the super thanks, which is coming right up here. Those go a long way for us. Again, we do this video for free. We get a lot of benefit from people watching like you and sharing the video on Twitter and on Facebook and LinkedIn and things. We appreciate that. But these super things go a long way too. So thank you, Mary and Paul, for that. And anybody else who can do that as well by clicking that icon there. All right, well, let's start off taking a look at the S&P 500 with the market forecast indicator. As you can see, we we finished down. We finished down about 7 points, but we did finish higher by about 60 some odd, over 60 points off the low of the day. So pretty good move, and that was actually most of the range. So we covered most of the day's range, which was average, which is a really high average right now. And we covered that throughout the day today. So a good move on an intraday basis. Obviously, if we'd have finished at the high, then that would have been a lot more bullish, but not quite. A little bit of a lower close there, but not too bad. Still, we got a higher high, slightly lower low, but keep in mind that lower low was into the gap there. When you look at the near-term line, like we stayed bullish enough to keep the near-term line at these extreme highs. Getting to the 90 level typically brings your intermediate line out of the reversal zone if it was down there, especially considering that it was not only below in the reversal zone, but it was also below the 10th percentile for a very long streak. And for a few days of that streak, we were below the 5th percentile. So very, very extreme lows. Getting to the 90th percentile really helps get that out, even if it's just temporarily, like we saw here pre-CPI. And remember, we have CPI coming out next month too. Next week, excuse me, too. So I hope this isn't another false front run of the CPI where the market's expecting a good one, only to get rocked to the core, and we end up with a multi-week fall coming out of it. I don't think that will be the case because, again, fool me once, fool me twice, kind of a thing. I have to ask George W. Bush exactly what that quote is. But you can see we also have not closed above these resistance levels. So these really important long-term lines, 38% retracement of the post-COVID rally, 23.6% retracement of the long-term bull market rally off the '09 low points. So those were really, those were important support levels that we had faked out once and then now not so much, right? So this is a breakdown the second time. You don't typically fake out twice at the same important support or resistance levels. So as of right now, we're still below those lines. We are above the 23% retracement, however, of this current intermediate decline we're on. You can see the 23% retracement of that long-term move is up here. So this is the year-to-date market sentiment decline we're on. That's up here. That also happens to be where the 38% and it's just above these lines. So that's getting above 38.75 will be a really important level in terms of a resistance breakout. Obviously, you'd be above your 30-day moving average too. Which case, if we're going to change the trend, we need to be 2.5% above that level. But that would be an important resistance breakout. Otherwise, moving into this area is essentially just moving into resistance. And really strong resistance at that too. Multiple Fibonacci lines off multiple time frames, sitting right on top of each other. With that 30-day moving average as well, it's falling, so it's red. These are strong resistance levels, pretty much all at the same spot. Your NASDAQ is a little less bullish because you notice it has not gotten above the 23% retracement of this current intermediate decline. The 23% retracement of the long-term declines actually lined up with the 50% retracement of this current drop that we're on right now. And then they happen to be both below those two red and black lines that are sitting on top of each other based off those long-term lows. So the NASDAQ's really struggling to kind of keep up, which again, you don't want the Qs to be struggling because that's the drivers, right? That's XOK, XLY, XLC. That's the big chunk of the S&P 500 is the Qs, a big, large portion of the S&P 500, the biggest portion. So if it's lagging behind the S&P 500, that's not necessarily the most bullish scenario here. And then finally, on the other end of the spectrum, the Russell is outperforming because, again, it is above that 23% retracement, well above the 23, still below the 38, so not really, not really quite there yet. You also see the 23% retracement of the long-term move also happens to line up with the 50% of this current decline. So again, lining on top of each other. Also below those two lines, remember they're above the S&P, the black and red lines on the S&P. They're also below those lines on the Russell. So, for the Russell to really change that long-term trend, we'd have to get above this, basically 2,000. So it has, it's been a little bit more bullish here the last couple of days, though it's much lower high. Did not do well today. It was down 0.75% today. So it had the biggest loss today, but it had the, really good move previously, more so. And this actually is out of the reversal zone already. Whereas the S&P and NASDAQ are probably another day or two away from getting out of the reversal zone. All right. Now let's take a look at the long-term move here. As you can see, we did get, so far, like we've talked about before, we have a higher close. You got an upper lower shadow, so we have the potential for a reversal, right? To get the reversal, see, we didn't get the reversal here until we closed above the body of that transition candle. So we have to close above this body next week to really kind of signal the reversal. That we got, again, coming off the June lows going into the August peak. So we don't quite have the reversal yet as bullish as we have been in the last little bit. You can see on the whole, too, the whole has turned higher. You got the bullish candles. You got a really bullish candle yesterday. But we got a barely higher low. You're probably going to get a lower close than that. At least the odds of getting a lower close than that is going to increase tomorrow. So let's see, how we do if we end up continuing to get a higher close. Remember, you get a lower close, you start to run the risk of a reversal. Obviously, you have the green hull, you have the parabolic SAR flipping to the downside. But see, we had that over here too, and it was very short-lived. And again, this was the CPI report, coincidentally, that we're going to get next week. So we'll see how that goes going into that same CPI report next week. If we take a look at some of the other oscillators here, well, let's look at the 3 green arrows first. Again, we're not bullish till we have 3 green arrows. We have 2 green arrows. So we don't have pink shading anymore. We do have 2 green arrows on the stochastics today for most everything, on the MACD yesterday. So, that's a good sign that we have, that we don't, at least don't have pink shading. But again, we need more than 1 day of green shading before we can say we're bullish now. So we don't obviously even have, again, we have to have 3 green arrows, which means we have to get above that moving average to get that 3rd green arrow. You notice we're still struggling at the 17-day moving average. And remember, the 30-day is above all those really strong resistance lines that are sitting right on top of each other right now. So it's going to take, and there's a gap between the 17 and the 30. You typically are more bullish when you cross both the 17 and the 30 at the same time. Here, you're just not, there's too big of a gap to cross above them at the same time, which means you typically just fill in. If we do get above the 17, we just fill in the gap between the 17 and the 30-day moving average. When you look at some of these other oscillators, you'll see that the negative indicator is still barely above 25. The positive has not gotten above 20. So again, not bullish at all. I mean, not that bearish anymore, but definitely not bullish. We are still way below the cloud. The red line is still way below the price. So the rate of change over the last 26 days is still very negative. We still have a very mature trend. We're above 80. We're below -5. So we still have a very mature bearish trend despite the rally. We're still below. We are above the green line, but we're below the blue line. On the Bollinger Bands here, we're up to the midpoint of the Bollinger Band width, which is starting to fall from very high levels, but we're not into the upper quartile, which is what you need to change the trend, right? When you get these falling bandwidth, that's great, but if you're stuck at the midpoint, then we just consolidate while it's falling. You have to get into the upper quartile like we did here to change that trend around. And we're not there yet. You can see also, I didn't show you the RSI and the CCI. They're not in bearish territory anymore, but they're not really strongly in bullish territory either. So, so we're not bearish. The bearish leg is kind of ended here temporarily on this current near-term rally, but we're also, but we're also not out of bearish territory here, much less in bullish territory. So we got a lot of work to do if we're going to turn bullish at all. And again, until that work is done, you don't expect that we will, right? Because of the strong bearish trend that we're on. So at some point in time we will, but I think we need more consolidation like this to occur. And you can see what it looks like here. We need more of that consolidation to occur first to get that MACD. See, that moving average has to get closer to 0 first, the orange line, before we finally get the turnaround, right? See, when you're too far away, then it takes too much energy to get there, and it just fails, right? Same thing over here. When you're too far away and you start to rally, you use up so much energy to get there, and it fails. So you need more of a consolidation if we're going to actually turn up and get these moving averages turning higher again, even if it wasn't quite the 200-day. So I think like this time that if we start to run up right now, we're going to fail because it's taking too much energy to get to these lines. We need to get that orange line up closer to 0 before we can actually turn it around. I actually believe before that happens, we're probably going to get another leg lower and form some kind of divergent low point where we'll end up closing closer to 3,200 by the time it's all said and done. But the MACD won't close at a lower low than that. We'll probably end up closing with a higher low by the time we ultimately get down to the low point of the year, which is so funny because every time we have a little swing like this, it's not uncommon, right? We've had this whole calendar year, we've had lots of good 3-day moves, right? This is not the first one. We've had lots of good 3-day rallies. You can see them all right there. We've had 1, 2, 3, 4. This is number 5 of a 5% or more rally. If I were to look at a 4% or more rally in 3 days, we had 1, 2. We've had a few in here. Basically 3, 4, 5, 6, 7, 8, 9, 10. 10 4% or more rallies roughly. And so this is hardly the first one, but every time that we do have one, everybody talks about, well, this is the low point. This is the low of the year. We're not going to go to new lows. And again, I don't necessarily think that's the case. And we talked about this before too, that the volume still is not confirming what we're seeing, right? Again, we are currently closing right now higher than where we were on September 22nd. Yet the volume is still much lower than where we were on September 22nd. So that shouldn't be the case if we are indeed turning this ship around. We've seen that across all these rallies, and that's why even this big one, right, that we were so far, like we were closing over here above these highs, and we were nowhere near being above that peak on the volume, much less above some of these other peaks, right? We weren't even close to that peak. We weren't even close to this peak. Like, I guess we were kind of right at this peak here with the volume finally when we got to that level. And so that's a big move above that high point. To not have more volume on this move than what you had on that small decline tells you a lot, right? It tells you a lot about the kind of move that we had there. And again, we're seeing very similar what's going on here right now. If you take a look at the VIX, it's interesting. I tweeted out that we've had five 2-day rallies of 5% or more since 2009. They've all corresponded with correction lows. But the VIX, out of all of those, in fact, here's the tweet. Let me bring the tweet up and I'll bring it over here and show you. Let me find it. Here we go. It's right over here. And I'll bring this over. So all 5 of these corresponded with correction lows. You can see one there, you can see one here, you can see one over here in 15. So they've all corresponded with the lowest points of corrections. And if you look at the volatility index on all of them, in 2011 we were at 43. This is the 2 days prior to this move, right? So the low point that produced the 5% plus rally in 2 days. So the VIX was at 43. The VIX was at 36 on 15 and 18. The VIX was at 66 in COVID, right? The ratio of VIX to VIX3M was at 125% or higher on all 4 of those. And this one, the VIX is at 31, and the VIX ratio is at 100, barely above 101%. And we're continuing to move lower. So this is hardly a correction low point because we're nowhere near 125%. We can't even get above 100% and stay there for more than 2 days. We've only had 2 2-day rallies consecutive closes above 100% all year. So we can't even get above 100%, much less 125. And again, the VIX was at 36, was the lowest levels. It did get it below 36 way over here, but again, this is the 5% rally over 2 days. It's supposed to be here or more likely well above 36, and that's just not the case right now. Nor is it, so I don't expect this to be, even if this is just a correction, I don't think that this is the correction low point. I believe if this is just a correction, I think we'll probably end up getting to 3,500 before we ultimately hit bottom. But I don't think so. I think we're starting a bear market and we're going to move our way down to 3,200 first before we get that last intermediate rally that is in the early stages of the bear market. Remember, bear markets don't start until after you've had 3 intermediate bullish rallies. We've had 2, and I think after we hit 3,200, we'll have our 3rd one later. So here is, if you look at when I say intermediate rallies, I mean the market forecast gets from being in pink, the green line gets from being in pink territory to being in the bullish one. So there's our failed pullback bounce, which is the first intermediate rally of the early stages of the bear market. This is our failed correction bounce, right? So again, that typically both of these typically occur above the 200-week moving average. The 3rd one occurs after you've broken the 200-week moving average, and we peak just right at it or still below it. So we're actually 5% above the 200-week moving average, so we still need to move down and then bounce up. Like I said, probably move down to 3,200, then bounce up towards this 35, 36, this 3,700 in this area with a good intermediate rally into the green. Then the bear market kicks in gear after that. That's when it really starts after all of that. So it's a lot more extensive than a nice little simple 20% rally. I mean, I guess that would be like your NBER version, your of the real definition of a bear market versus the the lazy media version of any 20% rally. Because again, when you look at any 20% rally, like because that's a really lazy way of defining a bear market, because that would mean that every rally that you get, and I'll go back 20 years, every drop of 20% more that you get, which you've only had a couple now, that would mean that if every 20% drop is a bear market, then that means every number in the green boxes should be the same too, right? Because 20% drop, 20% of what, right? It's a 20% drop from what peak? Well, the green numbers tell you the peak, so that's that tells you whether what a bear market is. I mean, that's a really lazy way, because you can see with all these 20% drops, not all the numbers in the green boxes are the same. So not every bear market is going to look the same. It's not going to be as simple as a simple 20% drop. I did show you that the higher high, slightly lower low. We closed at yesterday's high. It's a good sign. Again, the volume and the we're above 2%. We're not going to be in a bullish trend until we're back down at least below 2%, if not really below 1%. And then you can see the volume is at really, really high levels. Again, not high enough on the upswings to offset the really strong levels of volume on the downswings. That's why we can't turn the ship around. All right, now let's take a look at what's driving this price action here today. And again, interestingly enough, the dollar rebounded in a big way today, but so did commodities. Remember, that's the three-headed monster for market weakness for most of the year has been a strong dollar, higher commodities, and higher yields. And we got all three of those things today, which is one big reason why stocks were down at the beginning of the day. They did rally towards the end, though the dollar stayed strong, commodities stayed bullish, yields stayed bullish too. So, I mean, that's our three things. This commodity, of course, what's going on with OPEC and commodity prices. I don't know necessarily if that's what we want to see, because again, that's the whole bullish narrative for the Tom Lee rally, is that commodity prices are not going to go higher anymore, that gasoline and crude oil will stay low, that yields have peaked because of that, and stocks can just take off to the moon, right? Go back up to new highs. So, but with commodities, haven't consolidated pretty much since November or June the 9th is when commodities peaked. We're still well below that peak, and stocks are, not necessarily, if you look at, where's the S&P 500 been since June the 9th. June the 9th is right here. So this is where commodities peaked. They've been falling ever since, well off those highs, but stocks are still well below that June 9th low point. So we should be, if stocks are bullish because of falling commodities, we should be up here, right? Not, where commodities are not, the inverse of where commodities are not lower. So that's the issue right now that you're seeing. Commodities look like they're about to start to correct. We broke below, but it looks like more and more that this is kind of a pullback, and that we're going to get now our, pullback bounce where, whether or not, it ends up being a failed one or not remains to be seen, but where the intermediate line makes its way back, into bullish territory here. We kind of had a quasi one there, but not really much of one. But now, it appears that we're getting a little bit more of a rally up to the upside on commodities, and is expected to. A lot of people are expecting, with this agreement, this output production cut, at least to produce bullish sentiment towards commodities in the short term. Bonds were the other big mover, but bonds are so bearish right now, and they have been kind of consolidating for a while. I mean, we're forming a divergent low point, much lower low point on bonds, much higher, well below its 200-week moving average. So bonds have been in a bear market for a long time, and for that matter, way below that 200-week moving average. So I believe you're setting up for a divergent low point where you get a higher low with a much lower low, and that will set us up for bonds to whatever bonds end up doing, right? You'd have to, draw your Fibonacci lines from that peak all the way down to see ultimately when, where we get up to. But a move up to 118 would get you back to the 5-year point of control, and back up to probably where the 50-week moving average will be by then. And then I think we have to, again, you have to consolidate for a while. You have to get this orange line to get up closer to 0 before we can finally break through and maintain a bullish trend. Same thing we talked about before on the S&P 500. The dollar, had a big breakdown, earlier last week or so, but then back above the 17-day moving average with the MACD below its moving average. So we're still not quite, getting a lot of momentum to the downside yet on the dollar. Though we are getting close. Like we had this kind of breakout parabolic move. It still looks like that we might get right back below those 0% lines and start to retrace. Like this is the fluff, right? This is the, the fake move, the parabolic move, the, kind of the erroneous move that the market quickly corrects. And that, up until yesterday, it looked like that was going to be the case. And we'll see if today was kind of a one-off, a little bit of an anomaly bounce. If we get back below those 0% lines and work our way back down towards these Fibonacci support levels and get a little bit of a pullback there. See, we are way above like 1730, like the MACD is still peaking. So, the histogram's already peaked, but it looks like the MACD is going to be peaking. So we still have a long time to go before this dollar consolidates and starts working its way down. But you remember, being at this level, at these levels, is really, really bearish for the global economy. It's not, it's not very good for the dollar to be this strong. In 2000 is when the dollar peaked, and that ended up starting that bear market. So you don't necessarily want the dollar to be this strong. It tends to have, negative ramifications for the global economy, just like it did, back here. This 2014 rally, we had a global slowdown in 15 and 16 that was caused with, at the time, a really strong run on the dollar. And this is, this one makes this strong run on the dollar look like nothing, right? So that's and it's much higher, same pace or similar pace in terms of speed and the pace of the move, but at a much higher level, which can have a lot more severe ramifications. The global economies have already priced that in. Their CAPE ratios are really, really low. Long-term PE ratios are really low. They're about half of what the U.S. is. The U.S. obviously has not priced that in yet. And I think the U.S. is kind of hoping, like it's done in the past couple here, that these mega cap names will be safe havens again. But that's the issue. Is the question is whether, most likely they're not, because the Fed had negative real Fed funds rate then. The real Fed funds rate is not going to be negative now. It's going to be more positive than it's been in a long time, and it's going to stay more positive than it has been pretty much since the 2009 low point. So we're in a little different regime from a monetary standpoint, and that's going to prohibit these mega cap names from actually being safe havens. They will actually be more cyclical this go around, in my opinion. All right, so now let's take a look at how the sectors did. And you can see today it was a big move. I mean, this is not your typical market leadership, right? They have energy be so bullish and healthcare. I mean, now granted, technology, that's great. But you would like to see discretionary and communication services up here, and they lag the market. And interestingly enough, so did utilities and real estate. So I remember with higher yields, you get pressure in these interest rate sensitive sectors. So they actually were much, much lower today. So that's kind of an interesting dynamic, but not your typical risk on day. Again, I go back, the last 3 sessions. So this would be, the last 3 days here. Energy is up 12.5% in these 3 days. I mean, that's, and technology is up 7%. It's great, but discretionary is only up 3%. This is not your typical risk on move. Very dollar sensitive. It's very kind of reopen trade because you have industrials, materials, and financials outpacing the market as well. That's not the lasting kind of market rally that you'd want to see. You'd want to see XLK, XLY, and XLC lead the way higher because that's the Qs, right? That's the big dogs. That's you want the generals to lead the way because they got the highest market caps, because that's more sustainable than when the small caps, the smaller stocks within the S&P. Not small caps, but the smaller stocks within the S&P tend to lead the way higher. That's less sustainable and tends to peter out, like we've seen already earlier this year. I did want to take a look in the materials sector for our trade idea of the day. I want to take a look at Archer Daniels Midland. You can see it's had a nice little rally up to light green shading and the yellow line. I mean, it almost looks exactly like the market, except we didn't get as bearish. We got a couple clusters, but we didn't get as bearish on the intermediate line, and we're already out of the reversal zone. When you look at the long term, the weekly crossover chart, you can see we still haven't gotten to a death cross environment, but the PPO is well off of its peak, so we're not like taking off to new highs anytime soon. We did get a transition candle, so we've kind of halted the the bearish declines here. Obviously, when you look at the 3 green arrow chart, we actually did get 3 green arrows on Archer-Daniels Midland. Oops, kind of hard to see on this one. Let's look at this one here. So we actually did get 3 green arrows. Whoops, sorry. Here on Archer-Daniels 1, 2, 3. Of course, it takes more than one day. It takes more than a couple. It takes more than a couple days. But you can see it did. It is above the 200-day moving average, and it's above pretty much all the moving averages. It was above the 30 earlier today. But you also see that it's still inside the value area, most of this range, and it's still inside Fibonacci retracement levels, and it's pretty much attracted and gravitating towards the point of control. So when you look at some of these other oscillators, they're all neutral. The DMI is relatively neutral, a little bit above 25, but not very much below 20. So not a very trending indicator there. The RSI and the CCI are at neutral levels. When you look at the Ichimoku cloud, we had a little bearish trend going, it's gone. So we're neutral there, sitting pretty much right in the cloud, right at that blue line. So pretty much neutral indicators all across the board. So what I decided to do here was to come to the options chain and sell the 77.5 by the 75, sell the 92.5 by the 95, and do an iron condor spread. Here, let me get to a regular instead of being beta weighted. There's our iron condor spread and because we have earnings coming up. I can get a normal reward, actually a little bit more than a normal reward, but for about 2/3 the risk of normal. So which is good because again you have earnings coming up after October expiration, but before November, which these options are November expiration. So you can see my blue lines. If we get above this blue line, we're going to be out of the value area. We're going to be trending to the upside, above these highs, above the 23% retracement. We're going to be taking off. So I got a good upper break even. I got a good lower break even too, because I'd be back into the Fibonacci retracement zone right at the 62% retracement level. So as long as we stay inside these areas and stay around that point of control, then we can get a pretty decent reward for less than normal risk in a relatively volatile environment with earnings coming up. All right, well, that wraps us up for today. You've heard from me now. Now I want to hear from you. Use that link popping out in the top right corner of your screen. That takes you to our Market Outlook forum. Open up any new thread with any questions or comments you have. Reply to anybody else's thread. Let's keep this conversation going in between videos. Again, thank you very much for watching. Remember to subscribe to our YouTube channel. Hit that thumbs up icon. Comment on the video. Like us on Twitter and Facebook as well. Join us at marketscholars.com for free. Have a great rest of your Wednesday night, everybody, and we'll see you all next time.